Back in 2008, Halifax Bank of Scotland collapsed. Well, ever since, regulators have been trying to find out why and who's to blame. On Thursday, they finally published a report into the case. I'm joined by Caroline Binham, the FT's financial regulation correspondent, to find out what that report says. Caroline, welcome. We've waited 7 years for this report, and it costs £7 million. Was it worth the wait?
That's a good question, and I think many beyond the city are going to answer that question with a no. As you rightly said, this took £7 million. It has taken over 3 years to complete. It comes in the wake of an earlier report that was already done by a parliamentary commission, and it's rehashing events that took place a decade ago. And the upshot of this rather costly and time-consuming report is that there may yet be another costly and time-consuming inquiry before we get to any substantial settlement of these events.
Now, of course, it's 600 pages long, so there's a lot to wade through. It's fair to assume that there is information in there that we didn't know about before, but is there information in there that actually matters, that points the finger at anybody or allows definite action to be taken against anybody?
I think it's fair to say that there's no real smoking gun that wasn't already known about within those 500 pages. I mean, it's hard really to find anything new in what has already been a very widely reported story. However, the conclusions are pretty stark, and that is that the responsibility for the failure of HBOS rests really rather squarely with the board at the time and the senior management, but also that regulators also had their share of responsibility.
You could say that's blindingly obvious, but it's a shame that it's taken 7 years to get there. Now that it has got there, what happens next?
So the Prudential Regulation Authority and the Financial Conduct Authority, which are the two authorities that have been born out of the old Financial Services Authority, which did not come out of today's report with flying colours, they have both said that they are now going to examine whether there are new grounds for opening fresh investigations against the senior managers and board members of HBOS. They're going to come to that determination as soon as possible. We should expect a decision by the new year. But at that point, even if new investigations are launched, that will mean that at least 18 months to 2 years, if you consider that there has to be a fresh investigation, these people have to have due process and right of response before any determinations are published. So it's really going to be another 2 years before we see any potential director disqualified, which is the worst possible sanction, hypothetically.
Yeah, of course, because there is the time has run out effectively to enforce any kind of financial penalties on these people.
Indeed.
It's just a matter of disqualifying them from being directors.
Exactly. There is no time bar on the FCA disqualifying someone. A lot has been made about this time bar in the last week. However, what I would say is that actually that was a bit of a red herring, and the time bar that applied in the events in question back in 2008 financial crisis, the regulator at the time was only working to a 2-year time bar from the time that it was made aware of potentially dodgy information. So that meant that the time bar for fining these individuals lapsed in about 2010.
Final question. Could this happen today? In other words, if HBOS were to fail today, or if a bank like HBOS were to fail today, would management walk away scot-free, or does the current regulation provide a better backcloth for people to be pursued?
The regulators would certainly say that today is a very different environment. Andrew Bailey, who's the head of the PRA today, said that both the strategy of the bank and the regulation were very much creatures of their time. And since the financial crisis, we've seen a swathe of measures, both in terms of banks having to bolster their balance sheet on both capital and liquidity, which weren't in place at the time, but also much more rigorous regulation and supervision. And of course, this new senior managers regime, which intends to hold senior managers very much to account for failings on their watch.
Well, let's hope we don't have to test that for quite some time yet. Thank you, Caroline. Well, for more on this story and for banking stories in general, you can go to ft.com/banking.